I just want to talk about one of the calls that you made last week, which is it's time to buy global equities. And of course, not long after, probably just a matter of hours, we saw war break out in the Middle East. So does this cause you to revisit that call at all?
Absolutely. So there's been so many reasons for equity markets to worry about this year, starting with recession risks, higher rates, higher inflation, and of course geopolitics and the tragic events out of the Middle East are a painful reminder that these risks are clearly out there and continue to be there. Now, what we've been arguing over the summer is that, putting geopolitical risks aside, that the macroeconomic risks or the balance of the risks has improved. I don't want to sound overly bullish because the data still looks bad, but it looks less bad than we thought it would look. So the economies prove more resilient to all these risks than we've expected them to before. And of course, after the recent correction in the market, my targets look much more optimistic. The geopolitical risks and the war, of course, an escalation could cloud this positive outlook, but the market always estimates the balance of the risks, right? And you have seen that the possibility of peaking rates and rates being on hold, that was a very optimistic news for the market.
Well, I'm going to ask you to pick some rates right now, because we did hear from the Fed's Mary Daly today saying that the neutral rate now could be as high as 3%. Where do you see the neutral rate?
Absolutely. So there are two things about rates that impact equity markets, what is important for me. One, and of course this comment says that rates could be peaking. That's great for the market. This is why some parts of the market, equity markets around the world or sectors, could be oversold right now. But another issue is that it's going to be still high terminal rate to what the market and the economies have been used to over the past decade. So there'll be winners and losers out of that. But on balance, it's an optimistic view, I think, the fact that the rates could be peaking and coming slightly lower.
Beata, does that mean that you're keeping your overweight on the emerging markets? Because I know that you upgraded them back in July, but since then we've had a $1.8 trillion sell-off in EMs and now sinking to the lowest since the 1980s against the S&P 500.
Absolutely. So they look very cheap, right? And this is part of our thesis. So we've been overweight the U.S. all the way into the summer. Of course, the strength of the U.S. market relative to the rest of the world was driven by the fears that the next thing that high rates are going to break is inevitably economy, and they will break the economy hard. And that's what I've mentioned. These balance of risks have improved a bit, and we argue that it's time to move to more cyclical markets, right? So this relative call, the downgrade of the US recently, upgrade of cyclicality through Europe or the emerging markets, it has been flat in general. But what we argue going forward, especially after the recent correction we've been seeing, probably you should be buying into the more under-owned, depressed, from the valuation standpoint, markets.
You're still not buying energy. You downgraded them to underweight, but then we have this Middle East conflict going on. What do you think?
Of course, so probably out of all the changes that we've done recently, this underweight might be most at risk if the conflict escalates or continues, right? Because what we find is geopolitical risks, usually the first, the way they play out in the first place is through energy prices. So I would mention that if risks persist, this call could be at risk.
We've had rising yields really starting to hurt big tech. Do you feel like some of those big names were a little bit overvalued anyway? And is there much more upside there to be had?
Absolutely. So that's about the balance of risks from higher rates and risks of recession, right? So last year that was a huge rebalancing year for growthy sectors like tech. They derated a lot, and this year, especially post the banking crisis in the US, we started to more worry about the fundamentals and these recession risks. And of course, tech has proven more resilient from the EPS perspective, and with the latest sell-off that we've seen, we think it looks oversold, so we bought back into it a week ago.